Good afternoon, everyone. Welcome to the class on investment management. The purpose of this class is to discuss the previous year questions which came for investment management subject for VTU, and I'm going to discuss the question number 6B, which came in January 2019. So this question is basically about determining the risk on three stock portfolio. This problem is all about determining the risk for the three stock portfolio. So whenever we talk about a risk on three stock portfolio, so here there's another factor along with variance which comes, which is called covariance. So what is the formula for the standard deviation? Okay, what is the formula for the standard deviation of a portfolio for the three stock portfolio? So the formula for the standard deviation, so the risk on three stock portfolio, if I want to determine the risk on three stock portfolio, so the formula here, this is the formula variance I'm telling you. Then we'll do the square root, we get standard deviation. W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square into sigma 3 square plus 2W1 W2 covariance between 1 and 2 plus 2W1 W3 into covariance between 1 and 3 plus 2W2 W3 plus 2W2 W3 is equal to covariance between 2 and 3. Okay, everyone, this is the formula. Now, according in this formula, what is the formula of covariance? So, covariance between 1 and 3 would be the coefficient of correlation between 1 and 3 into standard deviation of 1 into standard deviation of 3. Okay, everyone, I hope everyone knows this formula. Okay, then going forward, what else we need? No, we need only this much. Okay, so let write down these values. Let's write down this value weight. So three stocks are there, so let down the value. So let three stocks are there. Stock 1, then stock 2, stock 3. Three stock are there. Stock 1, stock 2, stock 3. Their weight their weight is point 0.3, point 0.3, sorry, point 0.3, point 5, point 2, point 0.3, point 5, point. Okay, everyone. So what is the standard deviation? The standard deviation is uh, 6, 9, 10. The standard deviation is 6, 9, 10, 6, 9, 10. The standard deviation, all are in percentage. So this is in percentage. Okay. So find the variance. So find the variance. The variance would be 36, 81, and 100. Okay. Find the square of the weight. So if you find the square of weight, that would be 0.09, 0.3 square. This would be 0.25. This would be 0.04. Okay, everyone. Is this clear, everyone? Then the coefficient. This is coefficient of correlation. This is the coefficient of correlation. Coefficient of correlation. Coefficient of correlation. So the coefficient of correlation of 1 and 2, sorry, 1 and 2 is point. So this is not the way I can write it. So, so this much is fine. So now uh, this much everyone done. Everyone written this much. Everyone written this much. Please confirm. Everyone written this much. Yes or no? Please reply. Any doubt? Anyone? हाँ ठीक है. Okay. So now once you written this much, now let's do this next part. Calculation of covariance. Calculation of covariance. Now do the next part. Calculation of covariance. So covariance. Okay. So standard deviation of 1 is given as how much? 6, 9 and 10. No, 6. Standard deviation of 2 is 9. Standard deviation of 3 is 10. Coefficient of correlation between 1 and 2. So coefficient of correlation between 1 and 2 is zero point 0.4. The coefficient of the coefficient of correlation between 1 and 3 is 0.6. 1 and 3 is zero point 0.6. And coefficient of correlation between 2 and 3 is zero point 0.7. The 2 and 3 is zero point 0.7. Okay, everyone. So this much is given to you. Okay, so I can find the covariance. So what is the covariance between 1 and 2? So the covariance between 1 and 2 is coefficient of correlation between 1 and 2 into standard deviation of 1 into standard deviation of 2. So the covariance between 1 and 2, so the covariance between 1 and 2, that will be equal to coefficient of correlation between 1 and 2 is zero point 0.4 into standard deviation of 1, 6, standard deviation 2, 9. So how much you will get? Find this value. So 54 forza, 54 forza. So 54 forza, if I do 50 forza is 100, forza is 8. So 108, no, 116, 116. 54 forza is 116. So you will get 11.6. Okay. Similarly, the covariance between 1 and that would be coefficient of correlation between 1 and 3 into standard deviation of 1 into standard deviation of 3. That would be zero point 0.6 into 1. 1 is 6, 3 is 10. So 6 6 are 36. This is 36. Similarly, find the covariance between 2 and 3. So the find the covariance between 2 and 3. That is the covariance between 2 and 3 into standard deviation of 2 into standard deviation of 3. So covariance between coefficient of correlation is zero point 0.7 into standard deviation of 2, 9 and 10. 9 into 10. This is 63. Any doubt, anyone? So 0.46 into 9. 0.4 into 6 into 9. 0.4 into 6 into 9 is 21.6. This is 21.6. Hmm. Clear, everyone? Anyone, any doubt? This much done. Fine, everyone. We did the covariance calculation. Done. Can I go ahead? Suraj, done. Priyanka, Divya, Ranjita Yogeshwari done. Can I go ahead? Hmm. Okay, fine. So now we'll do the calculation. Now we'll do the calculation. So the now calculation of risk on three stock portfolio, calculation on risk on three stock portfolio. So the variance of the portfolio, that is W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square sigma 3 square plus 2W1 W2 into covariance between 1 and 2 plus 2W1 W3 into covariance between 2 and 3 plus 2W2 W3 into covariance. This is 1 and 3. This is covariance between 2 and 3. So the variance on the portfolio, W1 square, W1 square is 0.09, W1 square is 0.09, sigma 1 square is 36, sigma 1 square is 36 plus W2 square, W2 square is 0.25, W2 square is 0.25, sigma 2 square, sigma 2 square is 81, sigma 2 square is 81 plus W3 square, W3 square, W3 square is 0.04, W3 square is 0.04, sigma 3 square is 100, sigma 3 square is 100 plus 2W1 W2, 2W1 W2 plus 2W1 W2 W1 W2 0.3 0.5 0.3 0.5 into covariance between 1 and 2. Covariance between 1 and 2 is 21.6, is is 21.6 plus plus 2 into W1 W3 W1 W3 0.3 0.2 into covariance between 1 and 3 into covariance between 1 and 3, that is 36 plus 2 into W2 W3 0.5 into 0.2 W2 W3 into covariance between 2 and 3, that is 63, that is 63. Now do this variance on the portfolio. What is 9% of 36? Find this. What is 36 nines? What is 9% of 36? That is 3.24 plus what is 25% of 81? That is 20.25 plus what is 4% of 100? That is 4 plus 2 into zero point 0.3 into 0.5 into 2 into zero point 0.3 into 0.5 into 21.6, that is 6.48 plus 2 into zero point 0.3 into 0.2 into 36, that is 4.32 plus 2 into 0.5, so that is 1. So 0.2 into 63, that is 12.6. The variance on the portfolio is 12.6 plus 4.32 plus 6.48 plus 4 plus 20.25 plus 3.24, that is 50.89. 0.89. So the standard deviation of portfolio square root of 50.19. The standard deviation of portfolio is 50.89, that is 7.133. So I hope everyone understood this problem. These all the steps are there to solve the problem. The risk on three stock portfolio. So you need to understand a new form of risk which come in picture whenever the two variables come together. That is called covariance. Covariance is dependent on the coefficient of correlation between the two stock. The coefficient of correlation between the two stock can be from -1 to +1. If everyone understood everything, then we'll wind up the class.